Money problems in the United States rarely come from a single bad decision. They usually come from a missing system. People earn income, pay bills, save what is left, and hope the math works out. A practical financial framework flips that process. It forces money to move with intention before spending happens. This is not about complex products or clever tricks. It is about structure, sequence, and control. Americans who build strong frameworks reduce stress, avoid dependency on debt, and create flexibility even without extremely high income. The first framework is cash flow visibility. Many households know their salary, but do not know their usable cash. Usable cash is what remains after fixed obligations are removed. Fixed obligations include housing, utilities, transportation, insurance, taxes, and minimum required payments. A practical system requires mapping every dollar before it is spent. This is not budgeting in the traditional sense. It is cash flow mapping. Income enters, obligations exit, and the remainder is intentionally assigned. Americans who do this monthly see patterns quickly. They see which expenses quietly grow. They see which subscriptions provide little value. Visibility alone often frees several $100s per month without reducing quality of life. The second framework is expense tiering. Not all expenses deserve equal protection. Expenses should be grouped into survival, stability, and flexibility tiers. Survival covers housing, basic food, utilities, and transportation needed to work. Stability includes insurance, basic healthcare, communication tools, and essential maintenance. Flexibility includes dining out, travel, upgrades, and entertainment. When income pressure appears, flexibility is reduced first, not stability. This prevents the common American cycle of skipping insurance, delaying maintenance, or ignoring health needs to preserve lifestyle spending. Tiering allows fast decisions without emotional stress. The third framework is buffer-first saving. Many Americans attempt to invest before they can absorb a shock. A practical framework requires building a cash buffer that covers real expenses, not ideal ones. This buffer is not about growth. It is about resilience. Medical bills, car repairs, relocation costs, and temporary income gaps are common in the United States. Without a buffer, people rely on borrowing. With a buffer, problems are solved with cash. The buffer should be stored in accessible form, separate from spending accounts, and treated as non-negotiable. It is replenished immediately after use. The fourth framework is income durability. Income durability measures how stable and controllable earnings are. A single paycheck from one employer has low durability. Multiple income sources tied to different skills or clients increase durability. This does not require internet fame or speculation. Americans increase durability by developing transferable skills, negotiating pay based on measurable value, offering local services, consulting, training, repair work, logistics support, or process improvement. Durable income comes from usefulness, not exposure. The focus is on services that solve real problems for real people and businesses. The fifth framework is margin thinking. Margin thinking means separating revenue from profit in everyday decisions. Many Americans increase income but increase lifestyle costs at the same time. The margin remains thin. A strong framework protects margin. When income increases, only a portion flows into lifestyle. The rest strengthens buffers, reduces risk, or improves earning ability. Margin is also applied to time and energy. Over time, that destroys health, reduces long-term earning power. A practical framework evaluates income per hour, stress per dollar, and recovery time required. The sixth framework is obligation control. Obligations reduce freedom. Long contracts, large fixed payments, and inflexible commitments increase risk. Americans often underestimate how obligations limit choices. A framework prioritizes flexibility. Shorter leases, scalable services, and modular expenses are favored. Before adding a new obligation, the question is asked: can this be reduced or exited within 30 days if income changes? This mindset prevents financial traps that look affordable but become restrictive. The seventh framework is decision separation. Emotional decisions are expensive. A practical system separates planning decisions from spending moments. Spending rules are defined in advance. For example, large purchases require a waiting period. Annual expenses are divided monthly. Windfalls are assigned percentages before arrival. This prevents reactive behavior. Americans who automate decision separation reduce regret and impulse-driven spending without feeling deprived. The eighth framework is tax awareness without avoidance games. Taxes are a major expense in the United States. A practical framework respects the system while optimizing legally and ethically. This includes understanding filing status, deductions tied to real activity, retirement benefits offered by employers, and timing of income and expenses for self-employed individuals. The goal is clarity, not tricks. Paying what is due while avoiding unnecessary penalties, or overpayment improves cash flow stability. The ninth framework is risk layering. Risk cannot be eliminated, but it can be layered. This means combining buffers, insurance, skills, and flexibility instead of relying on one solution. For example, a strong buffer reduces reliance on insurance deductibles. Skills reduce unemployment risk. Flexible expenses reduce pressure during downturns. Layering creates redundancy. Redundancy is often seen as inefficient, but in personal finance, it is strength. The 10th framework is review rhythm. Systems decay without review. A practical framework includes scheduled reviews. Monthly reviews check cash flow accuracy. Quarterly reviews assess income durability and expense creep. Annual reviews reset goals based on real performance. Reviews are factual, not emotional. The purpose is adjustment, not judgment. Americans who maintain a review rhythm avoid sudden crises because problems are identified early. Finally, a practical financial framework requires identity alignment. Money systems fail when they conflict with personal values and lifestyle reality. A framework must match work patterns, family needs, health, and long-term direction. Copying someone else's model rarely works. The most effective frameworks feel boring but reliable. They reduce anxiety, increase control, and support consistent progress. Part 1 establishes the structure. Structure comes before growth. Without structure, effort leaks away. With structure, even moderate income becomes powerful. This framework is not about shortcuts. It is about building a financial operating system that works quietly in the background while life moves forward. A framework only matters if it works during stress, not just on paper. This section translates structure into action using situations most households face. A common failure point is inconsistent income timing. Many Americans receive paychecks bi-weekly, monthly, or irregularly. Bills arrive monthly. A practical framework converts income into a monthly operating amount. All income received during the month is pooled. Obligations are paid, and the remainder becomes next month's spending capacity. This removes paycheck anxiety and prevents mid-month shortages. The system does not care when money arrives, only how it is deployed. Another application is household coordination. Many households fail financially not because of income but because of misalignment. A framework requires shared visibility. This does not mean shared control. It means shared awareness. Both partners understand obligations, buffers, and limits. Spending autonomy exists within defined boundaries. This prevents conflict and duplication. When one person handles execution and the other understands structure, financial decisions become faster and calmer. Healthcare costs are a unique American challenge. A practical framework plans for healthcare as a certainty, not a surprise. This includes annual checkups, prescriptions, deductibles, and potential gaps. Funds are assigned monthly even when unused. This prevents medical decisions from becoming financial emergencies. Planning does not eliminate cost, but it eliminates panic. Transportation is another major drain. A framework evaluates transportation as a utility, not a status symbol. Total cost includes purchase price, maintenance, insurance, fuel, and downtime. The cheapest option is often not the lowest stress option. Reliability has value. Americans who align transportation choices with income durability reduce cascading failures such as missed work or emergency repairs. Housing decisions shape everything else. A practical framework limits housing cost to a level that preserves margin and flexibility. This includes rent or ownership costs, utilities, maintenance, and location trade-offs. Longer commutes increase hidden costs such as fuel, time loss, and health strain. Housing that looks affordable on paper can silently erode income durability. The framework favors sustainability over maximum size. Education and skill development are treated as capital allocation. Not all education has equal return. A framework evaluates cost, time, relevance, and demand. Certifications, training, and practical learning tied to existing skills often outperform expensive general programs. Americans improve income durability by upgrading usefulness, not credentials alone. Family obligations require careful integration. Childcare, elder support, and dependence introduce variability. A framework plans conservatively. It assumes interruptions, illness, and schedule changes. Buffers are adjusted upward. Flexibility is prioritized. Families that over-optimize finances without accounting for real-life stress experience frequent breakdowns. Unexpected windfalls are handled deliberately. Tax refunds, bonuses, or gifts are not treated as free money. A framework assigns them in advance. A portion strengthens buffers. A portion improves earning ability. A portion supports enjoyment. This preserves balance and prevents regret. Windfalls accelerate progress only when structured. Debt avoidance is embedded, not forced. A practical framework reduces the need for borrowing by strengthening buffers, lowering obligations, and increasing durability. When borrowing exists, it is approached cautiously with clear exit plans. The focus is reducing dependency, not moralizing behavior. Inflation pressure is managed through adaptability. Instead of chasing returns, a framework adjusts expenses, negotiates services, and improves efficiency. Americans who regularly review subscriptions, insurance, and service providers reclaim margin without reducing quality. Small optimizations compound quietly. Psychological sustainability matters. A framework that feels punishing fails. The system must allow controlled enjoyment. Flexibility spending is planned, not eliminated. This reduces burnout and rebound spending. Consistency matters more than intensity. Technology is used selectively. Apps and automation support visibility and discipline, but do not replace understanding. A framework works even if software fails. Simplicity increases reliability. The final application is long-term direction. A practical framework supports life transitions such as career shifts, relocation, or reduced workload. Financial systems should enable change, not trap people in outdated decisions. This requires periodic reassessment of priorities. When frameworks are applied consistently, progress becomes predictable. Not dramatic, not flashy, but stable. Americans who operate with structure experience fewer crises and more options. The goal is not perfection. The goal is control. This concludes the practical application of financial frameworks designed for the United States market.